Hello everyone, I am Kantaraju NP, Assistant Professor, Ananya Institute of Commerce and Management. In this session, I am going to explain cost classification for managerial decision. This concept we will discuss in Accounting for Managerial Decision in 5th semester of BCom, Tumkur University. Classification of cost means we are going to be categorized the cost according to the common characteristics. That means to say that these common characteristics are these costs are essential for the managers while preparing the plan of action related to their future plans. That's why while preparing the plan of actions or decision making, these costs they need to look. So that's why what are those costs? Number one is marginal cost. Marginal cost or variable cost. Marginal cost is the additional cost incurred in the production of one more unit of a good or service. That means to say that we can additional cost incurred in order to produce a additional unit of product. In order to produce an additional unit of product, raw materials are incurred, labors has to work on it, then many inputs has to be sacrificed by the organization in order to develop the finished product. That's why what are all the cost which is spent by the company in order to produce a product, all such cost we may call it as marginal cost. Those are we can say that these are product cost. Therefore, marginal costs are based on production expenses that are always variable, because of when marginal costs are incurred, production also may vary. When production is zero, then there will be no manufacturing cost. That means there will be no marginal cost, because marginal cost are the product cost or the production cost. That's why what all the production costs are there, that it should be looked by the management while their decision making. Then next comes to the out of packet cost. These costs may not be recorded in our books of accounts, but these costs we need to look while preparing the plan of action. That is, these costs are paid by individual or the employees of the organization, but these may be or may not be reimbursed. In future days, they may be reimbursed or may not be reimbursed. Such cost we may call it as out of packet cost or out of packet expenses. This is the direct payment of money that may or may not be later reimbursed from the employer. Such cost we may call it as out of packet cost. Then example for that, toll free, then parking free, which is paid by employee while attending any meeting on behalf of the organization to the any conferences or the seminars. So which will be paid by the employee, but these costs may be reimbursed, may not be reimbursed. Such cost we may call it as out of packet cost. The next, imputed or notional cost. The value of the benefit is received, but actual cost is not incurred. Such cost we may call it as imputed or notional cost. The value of the benefit is received by the person, but where no actual cost is incurred. The examples for that is that notional rent charged on business premises owned by the proprietor himself. When proprietor owned his own building, again he is going to charge a rent and he collected money in the form of rent. Then it is the imputed cost, because actual cost is not incurred, but they are going to receive the benefit from that. So that's why it is a notional in character and do not involve any cash outlay. So this is called imputed or notional cost. The next we are moving with opportunity cost. It's purely an economic cost. That means opportunity cost or loss of other alternative when one alternative is chosen. We are going to choose the one alternative among the several alternatives. We are going to talk about only selection one. but what about the rejected alternatives? We are selecting the best one, but the rejected alternative also gives a little bit results to you. Then you have to calculate the loss of rejected one also. So that's why the opportunity cost is the loss of other alternative when one alternative is chosen. So opportunity cost represents the benefit on individuals, investor or businesses misses out when choosing one over another. That is called it as opportunity cost. Then next I am going with shutdown cost. Shutdown cost we means to say that a manufacturer may face some difficulties like shortage of raw material, availability of requisite labor to produce the particular product, and that time he has to shut down his operations. Even he stops his operation, some costs are incurred, like he has to pay rent of the factory building, insurance of the building, depreciation, maintenance, electricity charges. Such costs generally incurred even though production process are not taken places in our organization. Such cost we may call it as shutdown cost. That means a manufacturer or an organization may have to suspend its operations for a period on account of some temporary difficulties. When companies' operations are shut down, some costs are generally incurred. Such cost we may call it as shutdown cost. Thank you.